I think the opportunity is increased in a multi-dimensional way. So firstly, there's more credits that the market is going to have difficulty pricing because they're either stressed or distressed or riskier than the market perceived before. So there's numerically more, but also there's more dispersion because it's more difficult for the market, which is no longer in a steady state, to actually price each individual credit. So it's more numerous, more dispersion within each credit. And the other thing I'll mention is that when I started out, the European high yield market was about 100 billion in size. And now it's about 7 times that. And the leveraged loan market is probably something similar. So you've had an incredibly aggressive expansion of leveraged credit over the last decade. And the reason you've had that is because rates are so low, many more companies could afford that leveraged cat stack because the risk-free rate was basically zero. So you've got a very significant change in the cost of debt coming at a time when you've got a record ever level of risky credit, of sub-investment grade credit. That's what makes our space so interesting. The outlook is extremely interesting for our strategy, and I think that's a medium to long-term outlook. And the reason is because if you look at the last 3 decades, 3 to 4 decades, what's happened to risk-free rates, i.e. government bond yields, is that they've declined very steadily. So if you look at the German Bund 3 decades ago, that was 9%, and it went down to obviously 0 and below 0. Now what's happened is you've seen a sharp reversal of both short-term and long-term risk-free rates, government bond yields. So if you looked at that on a chart, you would see that that's quite a startling change to the regime that's happened over the previous 3 decades that ended in December 2021. So with risk-free rates higher, it makes debt more expensive for every company and every person. And when you think about companies, if you're investment grade, now you don't want your debt to be more expensive, but generally speaking, you've got low leverage and you can easily afford the interest. But when you come to sub-investment grade, where we specialize, and particularly stressed and distressed, often the new interest rates are unaffordable for those companies. And to make them affordable, there has to be a restructuring of the balance sheet. And a restructuring of the balance sheet is a distressed situation, and that's what we specialize in.